Welcome to this explainer. Have you noticed your house hunting budget isn't stretching nearly as far as it did just 6 months ago? You are definitely not alone. Today, we are diving right into the hidden economic forces that are quietly draining your budget. We'll be breaking down the absolute latest data from the Federal Reserve, the Brookings Institution, and the Bank Policy Institute to show you exactly what is happening behind the scenes. Seriously? Even though official inflation looks stable on paper, your wallet probably tells a totally different story. There's a specific reason why the 2026 interest rate climate is hitting personal housing plans way harder than anyone expected. And let me tell you, it goes so much deeper than just the sticker price of a home. We are diving into the hidden costs you must account for to stay afloat. Section 1, the shrinking housing budget. So, what does the 2026 housing market actually look like under the hood? Well, today, we're essentially playing the role of financial detectives. We've got to uncover these hidden structural costs, the ones that are totally invisible on a standard real estate listing. We're going to look at a massive regulatory backfire in the banking sector, what's actually happening on the ground for community organizations, and the honestly surprising way the government calculates your cost of living. Section 2. The Federal Reserve's blind spot. Our first major culprit? It's a massive oversight at the absolute highest levels of economic policy. Recent research from the Brookings Institution reveals this fascinating and honestly kind of frustrating disconnect. You see, official inflation metrics here in the US, like the Consumer Price Index, focus almost entirely on rent. They use this concept called owner's equivalent rent, which is basically guessing what a homeowner would pay if they were renting out their own house. But here's the catch, and it's a big one. This method completely misses the actual real-world reality of skyrocketing mortgage rates. Between 2022 and 2024, mortgage rates literally more than doubled. That drove up the required monthly payment for new buyers immensely. Yet somehow, the official price index for shelter didn't directly capture this massive spike in borrowing costs. Now, the irony here is absolutely striking. Federal Reserve rate hikes did, technically speaking, cool down housing sticker prices and construction costs. But at the exact same time, those exact same rate hikes triggered a massive, unavoidable spike in the cost of borrowing. So think about it from a prospective buyer's point of view. Sure, the sticker price of the home might have stabilized, but your actual monthly user cost, once you factor in that new 6 or 7% mortgage rate, has absolutely skyrocketed. And because of this massive measurement blind spot, the very real acute pain of the prospective homebuyer is just getting totally lost in the aggregate data. The Brookings research actually points out that the number of first-time homebuyers plummeted by 36% between 2021 and 2023. I mean, 36%. Purchasing power simply evaporated. Because official inflation metrics are structurally designed to miss the direct cost of new mortgages, macro policy decisions can inadvertently leave millions of people totally trapped as renters. Section 3. The hidden escrow fee track. If that mortgage rate wedge wasn't enough of a headache, our investigation brings us to a literal hidden fee passed down by banks. Let's quickly define this first. An escrow account is basically a forced savings account that your bank holds onto. You pay into it every single month as part of your mortgage, and the bank uses it to make sure your property taxes and homeowners insurance are paid on time. Now, historically, banks held this money and just kept whatever interest it generated to cover their administrative costs. Well, feeling this was unfair to consumers, several states passed laws requiring banks to pay consumers a minimum interest rate on those escrow funds. It sounds like a huge win for the consumer, right? Well, actually, no. An incredible study by the Bank Policy Institute using Home Mortgage Disclosure Act data shows this completely backfired. Lenders have numerous free levers to compensate for lost revenue, and surprise, surprise, they used them. The researchers looked at this perfect natural experiment. In 2022, Iowa actually repealed its escrow interest law, which had been on the books for decades. And by comparing Iowa to similar states that never even had the law, the data revealed something totally stunning. The exact second that law was repealed, the average upfront origination fee charged to consumers in Iowa instantly dropped by $173. Yeah, this proves that lenders were simply taking the cost of that state-mandated interest and passing 60 to 90% of it straight back to the buyer in the form of higher closing costs. The regulation didn't generate any new wealth for the consumer at all. It literally just shifted a slow drip of interest into a big upfront fee that buyers were forced to pay on closing day. Section 4. The low-income housing squeeze. Now, what's genuinely concerning here is who actually ends up paying the highest price for these hidden fees, because it is definitely not evenly distributed across the market. When the Bank Policy Institute broke the data down by income, they found this highly regressive cross-subsidy. For the lowest income borrowers, that drop in origination fees after the repeal was actually $287. Meanwhile, for the highest earning quartile borrowers, zero. There was no statistically significant change whatsoever. So this well-intentioned law essentially penalized the lowest income borrowers with a massive upfront fee, while wealthier borrowers were totally unaffected. The rule actually lowered the overall likelihood of low-income applicants getting a mortgage in the first place. And we see this all trickling down to the ground reality. If we look at the Federal Reserve Bank of Cleveland's March 2026 Community Issues Survey, it maps this out perfectly. A staggering 61% of community organizations are reporting that affordable housing availability is still steadily declining. And just to put that into perspective, this marks the 9th consecutive survey since 2022 where the majority of respondents noted a drop in affordable housing. These community organizations highlight exactly what's happening on the front lines. Low to moderate income households are just being squeezed from absolutely every side by a perfect storm. It's not just rising rents and limited housing supply. It's sharp, painful increases in property insurance and property taxes. And think about it. These are the exact costs that require larger escrow accounts, which, as we literally just learned, trigger higher hidden origination fees in heavily regulated states. The whole shebang is just compounding on itself. Section 5. Navigating the 2026 market. So understanding all this macroeconomics is great, but how do you actually apply it to your own house hunt? That is what truly matters right now. When building your budget this year, you absolutely must over-prepare for these specific hidden costs. A standard online mortgage calculator will show you your principal and interest, sure, but it will not accurately model the surging insurance premiums, the rising property taxes, or those elevated upfront origination fees that banks are using to offset their regulatory costs. You need to budget a significantly larger cash buffer for closing costs than you would have even just a few years ago. The absolutely crucial takeaway here is this. The official headline inflation measurements are structurally designed to miss the acute pain of purchasing a home right now. Just because the Consumer Price Index says shelter inflation is behaving a certain way, it does not mean the actual user cost of acquiring a new mortgage has stabilized. You have to look beyond the official numbers at the actual ground reality of borrowing costs and hidden lender fees. As you navigate this highly complex market, we really have to step back and ask a serious question. If well-intentioned state regulations continually backfire into higher upfront fees and broad monetary policies continue to ignore the direct, massive cost of mortgage rates, what happens to the dream of the first-time homebuyer? Will the invisible architecture of housing finance eventually price them out entirely? It's a critical question to consider as we watch the 2026 housing market unfold. Thanks so much for joining me for this explainer.